Hey everyone, welcome to the final bar. Today we're going to talk about the mega cap tech trade that just will not die. I've shown so many charts and I've reviewed them so many times of all these bearish divergences, and despite any negativity that I can come up with, charts like Microsoft and Amazon, the FANG trade, the FANG man trade, whatever we want to call, they keep going up and to the right. So until that trend stops, you have to believe that the trend is going to persist, and that's sort of where we're at. Today we're going to hit on a couple groups maybe that are not as resilient as those. We'll hit on those later in the show. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at these markets together, try to get our head around the insanity of what is happening. And I don't mean to be giggling about the markets, but it's just as I'm preparing for the show, as I'm looking at this, I'm looking at social media. I'm seeing, people like Jim Cramer saying like, this is the most crazy thing I've ever seen with these mega cap names continuing to lead, and it's hard not to disagree with that. I mean, because you see these trends that continue higher, but as we've talked about for months now, as we've seen the XLK continue to perform well, as we've seen the mega cap tech trade work, all the things we've talked about, divergences, potential for downside, that's all speculation, that's all anticipation of what could happen. But at the end of the day, I am certainly a trend follower, and that is what I advise all of you to focus on if you're more of a longer term investor, because that's what works over the longer term. So in general, you have to identify where the trends are, and in general, stick with trends that are working and lean away from trends that are not working. And I think if you learned anything from today, it's that the tech trade at this point is continued to working, but it's not complete. And so we're going to talk about some of the other groups that did not fare as well today and what that might mean for us. I want to get on to the schedule. I was talking with producer Gretchen about last week's event. We had a week-long special charting the second half. And if you missed any of those, go to our YouTube channel. It's such amazing content. We had a market forecast panel on Saturday that was so much fun to record with some really thoughtful analysts giving their strategies for the rest of the year. Coming up in the next 2 weeks on the final bar, we have just a wonderful lineup of guests. Tomorrow, we have Andrew Thrasher from Thrasher Analytics. On Wednesday, the 22nd, Gary Dean from sentimenttiming.com. On Thursday, Al Brooks from the Al Brooks Trading Course is going to join us. Next week, on Tuesday, the 28th, we have Keith Fitzgerald from keithfitzgerald.com. And then on July 29th, next Wednesday, we have Louis Yanis, and founder of WealthNet, and Lewis is a really thoughtful analyst and I would think of him as more of a quantitative analyst. And I've always been fascinated talking to guys that approach the market more from a quantitative perspective, because there's so much that you can do to upgrade the way that you consume data and how you interpret it. And I think we're going to find with a couple of these guys, with Lewis, with Andrew, and others, there's a lot to learn there. So some wonderful guests coming on. I hope you'll be along the ride with us here on the final bar every weekday after the close. Let's look at the markets, and usually I start with the S&P 500. I'm going to go somewhere else today for good reason. We're going to start with the Dow Jones Industrial Average. Now, before you ride me about the Dow is not a great benchmark to follow, I agree. And before you say the Dow is 30 stocks and it's not representative of everything, I totally agree. I agree, and I say those things as well. But the reason why it's helpful to look at right now is by comparing the Dow to the S&P to the NASDAQ. And if you go to your dashboard, you can easily click through these first three charts and you will see what has happened to this market. And it's not a new theme, but it's become magnified today. The Dow was flat today, closed right about where it closed on Friday, sold off out of the open. It rallied toward the, after lunch, and then came back and literally finished flat for the day. The S&P 500 up 0.8%, so finished just above 3250, and that 3250 level is what we've been talking about. It's continuing to test upside resistance. The question is, can it close above there, which it did? Can it follow through tomorrow and through the rest of this week? I think that'll clear the way very quickly to 3,400. I'd want to see confirmation tomorrow, which is what I'll be looking for. But look at the NASDAQ, up 2.5%. The NASDAQ composite, the NASDAQ 100, up almost 3%, reaching almost 11,000. So this is where we're at with technology leading the way, driving higher. And when you take the overweight of technology, even though there's still some tech in the Dow's more of the traditional representation of the economy of the U.S. It's flat today. If you look a little deeper, look at mid caps down 0.6%, small caps down 0.6%. So we're back to this risk on, but risk on in the form of mega cap tech, of the really speculative but yet conservative defensive tech trade that has been working. This was a return of the FANG dominance. It's unusual how much these have continued to go higher with so many things going lower. What's not unusual is for a small subset of stocks to do very, very well. I think the way that this has persisted, given the macro headwinds that we have around us, I think is what's so unusual in my opinion. Now let's look at a chart of the S&P 500. As I mentioned, we've talked about this 3250 level. This is, essentially 3230 or so is where we hit resistance the beginning of June. We retested that 3 out of the last 5 sessions. And today we have finally closed above. And I mentioned, I want to see it close above 3250. We got it today. The question for me is tomorrow, do we follow through to the upside? If we do, I will be the first to tell you S&P 3400. I think you have to expect that. But I'm going to want to see some follow through to the upside. That would confirm a breakout of this range. That would confirm the potential for further upside. One thing to know, right? So there are plenty of question marks on this rally, but there have been question marks for much of the rally, to be honest with you. Can the market continue to rally driven by a small number of mega cap stocks? Obviously it can, and it can continue to go higher much further than you might expect, given that as the overall framework. It's worth noting the S&P was overbought when it made, these highs in early June. We are nowhere near the overbought range now. So if you stop the clock today, if we tank tomorrow and go back to 3150, this will look like the most obvious bearish divergence in the history of the S&P 500, I think. But again, that's assuming that this uptrend stops. If the S&P continues up to 3,400, this RSI line could conceivably continue to go higher and go past 70, become 80, whatever it is. So it's not a divergence until this stops going higher, and I think that's what I would be looking for right now with the chart of the S&P 500. I just want to touch on a couple other macro things. We're going to get to sectors in a bit, and we're also going to do a segment, Shifting Stocks, where we focus on bottom-up stock picking. So I just want to pivot over to the Mindful Investor Live chart list. We went through this in detail on Friday as part of our Wrap the Week segment. So if you missed that, go back to it. Looking at the market trend model as a reminder, thinking of the top-down macro perspective, the trends across the board are positive. Now, there are pockets of the equity universe that are not holding up as well. And again, we'll review some of those a bit later, but it's worth noting that the long-term model continues positive. The medium-term model using the weekly PPO remains positive. The short-term model using just the change, the momentum of the medium model, also positive. So all across the board, the trend continues positive. The breadth measures continue to be positive for the S&P, breaking to new swing highs. Continue to be neutral for the rest of these. I didn't change this color, and I probably should have, noting this neutral configuration for the small cap breadth, but certainly continue to be neutral for mid caps and for the New York Stock Exchange. If it breaks above that swing high from June, I would turn them green and suggest that they're more positive than negative. We're seeing some expansion in new highs. Again, today, I think we will see this number appreciate pretty dramatically as we digest all the rallies today and where all they're at within the S&P 500. But on Friday, we had 40 out of the 500 stocks making a new 52-week high. That's a non-zero number. That's what, 8% of the S&P. So, certainly potential for further upside. And the final one is the fact that over 50% of the S&P above their 200-day moving average, as we've talked about. Bull markets tend to have that as a configuration. We've got it. So overall, from a top-down, when you look at the broad indexes, I think you have to acknowledge that trends have been positive. They remain positive. Any question marks are when you look a little deeper. You take the overweight of mega cap tech away. When you look at small cap and mid cap, it's more neutral. When you look at some of the other sectors like financials, certainly more negative than positive. Energy sort of rolling over. But again, when you look at the broad indexes, because of the strength of tech and the mega cap trade continue to be positive. Let's move on to our next segment, sector setups. And as I bring up this sector chart, I want to remind you, so on Saturday, we had our market forecast panel, and I'll try to include some of the insights that we got from everyone. I think it's worth noting from a macro perspective, we talk about, big picture stuff. All 4 of the panelists, and it was Greg Schnell, Julius DeKempener, Grayson Rose, and John Kosar joined us. all four of them, I asked them, do you think what will happen first by the end of the year? The S&P breaks above 3,400 or below 2,800. All four of them said they saw the S&P breaking above 3,400 before the end of this year. So breaking new highs before the end of 2020. In terms of what they would be most overweight or what they think would outperform the most, none of them picked the S&P 500 though. Most of those picked non-US stocks like a EFA or something like that, or gold. One of the four picked gold. John Kozar, I want to say. So now we talk about sectors, and I think it's worth noting out of my four strategists, I asked you which sector do you see leading or the top performer going through the end of the year, and I had two say technology and I had two say materials, and it's interesting to know that both of those sectors obviously rallying pretty well today along with the rest of the market. But materials is actually an interesting one. There was a lot more discussion about commodities than I anticipated going into the panel. And Greg Schnell, who's based in Alberta and who's my sort of go-to thought leader on commodities, has some great charts of copper, great charts of gold, all sort of making that case for materials. Let's look at what the rotation graph looks like today. And this is using the RRG. This is Julius de Kempener's design. Check out his show, Sector Spotlight, if you're unfamiliar with this visualization. But quite simply, further to the right means it's outperforming the most, and that's why the XLK has been the strongest sector, according to this visualization, for many, many moons. It's interesting. It's actually heading in a southwesterly direction. Again, this is based on weekly data, so it's not taking just today's move into account. It's the broader trend, and you know that tech over the last couple of weeks, we've seen a bit of a hiccup as some of those larger names have pulled back, but overall still the strongest of the 11 sectors, followed by consumer discretionary, communication services, materials. What's interesting, the only one of the four of those that's actually heading the direction of improvement northeast, it's materials. And again, so when a number of them, the panelists suggested materials, I thought of this visualization, looked at it, and I sort of see where they're getting at. Interesting to note, industrials and financials coming in this right direction in the improving quadrant. But overall, when I'm looking at the individual charts, I'm pretty unimpressed by what I see with financials. With some exceptions, stocks like BlackRock are actually holding up very, very well. But the average big bank, not great, especially on a relative basis. Industrials, you have Boeing, not great. You have airlines, not great. And so there's a lot of not great in some of those sectors. It makes me hesitate a little bit. Healthcare, actually, what I think is most interesting, has rotated now into the lagging quadrant, and it's a you might think it's a bit of a head scratcher because you think of biotechs as being healthcare, and I think when you think of Regeneron or some of those stocks, the IBB, for example, that have gone to continued highs, it's hard to think of healthcare being one of the weaker sectors on a relative basis. But you have to remember that when you get exposure to biotech through healthcare as a sector, when you're looking at the XLV, you're also getting big pharma and other stocks. But excuse me, having said that, within healthcare, things like medical supplies, charts like Thermo Fisher Scientific come to mind, DHR, those are names within healthcare actually in pretty good uptrend. So it's interesting when you think about sector rotation, any way you measure it, you keep getting drawn to these sectors with the big mega cap names that are showing such resilient strength. So when we look at the candle glance page of the 11 S&P sectors, the ones that jump off the page as being in consistent uptrends from my eyeball, it's technology, it's consumer discretionary, it's healthcare, really. I mean, breaking to new swing highs, and it's materials, which is actually a really interesting one with the XLB back above 60. When you look at technology, we'll dig into some of the other sector themes here. With tech, I've had this green arrow on the chart for a while now, just showing this consistent outperformance. And if you did nothing but just bought the XLK at the market bottom in 2018, December 18, and just went away somewhere, you would have outperformed the S&P by about 29%. You would have had plenty of drawdowns, a 30% plus drawdown here February to March, but overall you still would have outperformed the S&P handily and not doubled your money, but it done pretty well coming out of the December lows. Just looking at that consistent uptrend in tech. What I'm not showing here, but we'll add very quickly, is sort of my standard look, incorporating RSI as well. And again, you asked me what concerns me besides what we've talked about so far. It's the bearish divergences, right? You have higher highs in tech, you have lower peaks in the RSI. What's happening right now is the XLK made a new 52-week high today. You can see that the RSI did not make a new high today because each time the XLK has gone higher, you've had lower peaks in the RSI. Now, this one right now is still active because the price is going higher. If we continue to see an uptrend and higher highs in the XOK, you would see the RSI potentially, break this divergence and move higher, sort of telling you that the divergence was not correct, and that we're actually seeing more upside. What you look for is once this high is established, once we pull back from that higher high, and then you can confirm a lower peak in the RSI, that's when the divergence sort of locks in here. So, at this point, it's sort of a wait and see mode as the trend goes higher in something like technology. Looking at materials, I think we had this as one of the 3 and 3 on Friday or Thursday, one of those days. But I think it's worth pointing out here. Remember, when you look at the XLB, my default way of looking at charts and the default way we illustrate charts on StockCharts is using adjusted data, meaning you're adjusting for dividend. So as you go back, the prices are going to be adjusted for dividend payments, which will change the value of the shares. And we do that so that the indicators are more consistent. So when you're looking at something like materials and you're seeing where it's at and you're saying, all right, well, it looks like it's testing that January high, all you need to do is put the underscore in front of XLB, which I'll do here. And you can see if you go back for a couple of years, we're actually going to go back maybe 3 years, update that chart. You can see that actually where we're at is right where we've been at on a pure price basis, unadjusted data. This is where we were in mid-2018. This is also where we were in late 2019, and now we're right back up to that congestion range. So this range right around 61 or so, 61 to 62, is where the XOB has topped out pretty much every time for the last 2.5 to 3 years, with the exception of the 2018 high around 64. So we are up again. Instead of breaking to new highs, we're actually up against this significant resistance for materials. And again, with things like this, the risk reward doesn't seem super attractive because we're right up against huge resistance and we have a lot of potential downside. Once you break above those previous highs, I think the risk reward changes a little bit because you've shown that the price can go higher. And that means I think the potential for further upside certainly increases. Boy, it's tough to encapsulate all of this, but when I'm thinking about sectors, I hit on some of the key themes there. Also, that came out of the panel on Saturday. We had a really good discussion about some sector themes as well. We need to take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. I'm your host, Dave Keller, here at StockCharts.com. As a reminder, we love hearing from you. We love answering your questions on our mailbag segments. The next one's going to be tomorrow on Tuesday's show. So do me a favor, if you have any questions about the markets, particular charts, particular indicators, whatever it is, shoot us an email, thefinalbar@StockCharts.com, or on Twitter, just tag us in a comment @FinalBarSCTV. We'd love to hear from you and answer one of your questions tomorrow. Let's get to our final segment today called Shifting Stocks. And the idea here is we've now talked about the top-down macro. We've talked about some sector themes that have emerged. Now I want to focus on bottom-up stock picking and look at what has emerged. Now, a little while ago, maybe a couple of months ago, I forget when exactly, I sort of came up with this idea of what I called the mindful six. And the idea was the S&P is doing one thing, but I want to look at 6 names that I think represent a good basket of stocks to follow. If this basket of 6 stocks remains in an uptrend, is able to break above previous highs, then I have to feel bullish overall about the breadth of the market in terms of these different companies with different models are able to move higher. If these stocks are breaking below support levels and are unable to eclipse their previous highs, then that would make me lean a little bit more negative. And it was just a way to try to get away from the mega cap leadership and think about some of the other stocks, and I might want to pay attention, maybe that next level down. So these are the 6 names. I just want to update because we haven't looked at them as a group in a little while, and I will show you why, to be honest with you, they've actually been fairly resilient. So we're going to start with Applied Materials. This is obviously a semiconductor name within the technology sector. You can see we sort of came up with this idea about a month and a couple days ago, maybe. I want to say maybe early June. I think this is after the June peak and they started to pull back a little bit. That's right. They tested, all had support levels. So I sort of put these pink lines hitting on these lows. It was the pullback off of the June high. And the question was, do we remain above or do we break below that line in the sand? Applied Materials has remained on the upper end of that range. Has actually continued in an uptrend. Did not quite get quite above its previous resistance today, but overall remaining more positive. The negative actually did almost do it, 63.73, just actually a new closing high for the uptrend there. So it's actually pretty impressive. Chart number 2 is Morgan Stanley. I mentioned within financials, there are some relatively unattractive charts, things like regional banks. Some of the larger banks come to mind, but Morgan Stanley actually has already broken above its swing high from June. So that's 2 of 2, eclipsing their June highs. One that has not is Starbucks, and you'll see 2 of these names certainly have not done that, maybe a little more, but Starbucks is one that I would argue, looking at the chart, still sort of testing that support just below 72.50. And again, if it's able to hold that support, that's fine. I'd still see the chart as sort of neutral. It's been range bound. It's been underperforming because the market's been doing that, going up and to the right, and it's sort of stalled since the June high. So not bad, not breaking down, but not really making new swing highs like the first couple names. Number 4 of these 6 stocks was Cisco. So we're back in technology, but seeing this is has not broken above its June high yet. Holding up okay. They were nowhere near its 200-day, nowhere near the support level. It's more on the upper end of that range. So overall, I would say still neutral. Nike actually has made a pattern of lower highs since we talked about this. It has not broken down through support. The 200-day moving average support levels all right around 93. So that's sort of the key line for Nike to hold, and it's done it so far. But again, compared to some of these other stocks breaking new swing highs, you can see this is more on the negative side. And then Disney was the first to actually break below support, but it rotated back above it. So now it's trapped between the support level just below 110 and also the 200-day moving average around 124, 125. That's where it actually found resistance back here in June. So Disney also neutral. So out of these stocks, I see 2 that have broken above their June highs. The other 4 I would classify as still neutral, still sort of in that sideways trend, having not broken above their June highs, but not broken down through support. So this basket we're going to keep looking at going forward and seeing if some of these names can participate. And again, this is a way to kind of get away from the market cap weighted, mega cap driven S&P or NASDAQ, which is driven by a small number of mega cap names that are in such strong uptrends. This is more of an equal weighted measure of sorts. And again, it's still pretty large companies. Don't get me wrong. If we had small caps in here, it might not look even as attractive, but this is just trying to get away from the Fangman trade and look at some of the other names. And overall, 2 positive, 4 neutral at this point. I want to rapid fire go through as many individual stocks as I can get to very quickly here. There are a couple of stocks that are facing resistance at their 200-day. Verizon comes to mind. AT&T's pulled back as well. So these are sort of the traditional telecom parts of communication services. What concerns me about Verizon, besides the fact that it's just been underperforming because it's not been in a good uptrend, we've now had this pattern of lower highs. It's now found resistance potentially at its 200-day moving average with an RSI around 60. That tends to be what a bearish phase looks like. And so it feels like it's in the upper end of this downtrend range, which makes me want to lean away from stocks like AT&T and Verizon. In terms of what has been resilient, Alphabet, Amazon, we might get to here in a minute. I mean, these are stocks that, just rallied significantly today. Going into today, I'm looking at these pullback levels and just seeing if we can remain above these swing lows. We're still in pretty good shape. And as you can see, this all of a sudden looked much more attractive very quickly. If we're able to get to a new swing high, this is a new closing high, new 52-week high for Alphabet, you'd want to see obviously some further upside. In terms of other trends that are pretty interesting, McDonald's is actually an interesting stock within consumer discretionary, back above its 200-day. This happened last week. It sort of gapped above it, but closed lower and then didn't really go anywhere. It's interesting to see if this stock is able to hold the 200-day because it's got upside to previous highs for sure. But overall, it's sort of right at that level where you want to know if it follows through on the breakout or if it starts to break down through the 200-day. Where you don't need glasses to see the uptrend is with Amazon. So a lot of these names pulled back last week, of course, but you can see Amazon just returned to the upside, up almost 8%. It was up a little more there, just around 3,200 for the close. So this type of stock doing this is going to elevate all the indexes very quickly because of that, because of the weight of those stocks. Kraft Heinz is one we talked about, going into last week, breaking above swing highs, pulled back a little bit today. So it'll be interesting to see if it's able to hold 34. That's the breakout level, sort of breaking above that June high. Also within consumer staples, there's some interesting charts in there. Costco and Walmart look pretty similar right now. They were both overbought going into into the first week in July. Have both held up okay, but not continuing higher. And I think you have with both of them pretty clear support levels on the previous. On where they broke out from, seeing if they're able to hold those. Also worth noting within consumer staples, the tobacco names, Altria, Philip Morris, both testing the 200-day, pulling back today off of there. So it'll be interesting to see if they're able to hold those. Energy across the board looks relatively ugly, and I'd show you the charts, but I think you can find them. Occidental, ConocoPhillips, Chevron, and they're all sort of downtrends, lower highs, lower lows, underperforming. Not my favorite sector, to be honest. BlackRock within financials, as a reminder, don't get too caught up in financials aren't working, which is an easy way to summarize the sector. And I don't disagree, but just remember there are stocks within that sector that might surprise you. BlackRock comes to mind, having just broken above its February high on February, pulled back a little bit today, but overall still in a very constructive position. And the relative strength has actually held up pretty well. Morgan Stanley, we talked about earlier, and you can see that that's making new swing highs as well. And again, higher highs and higher lows are an uptrend. What concerns me here is the bearish divergence that might be forming. But again, similar to what I've seen with some of the big cap tech names. Biotech has been the story within healthcare, but I think it's worth noting, I mentioned a couple of these, I glanced down at my list earlier. Within medical equipment, you have Danaher, DHR, with a pretty decent uptrend, making another 52-week high. Also within medical equipment, you have TMO, Thermo Fisher Scientific, again making new highs. Both of those, sort of in that overbought region, but overbought means up a lot. I just wrote a post about that last week, I want to say, on StockCharts. So check that out as well. Tech overall has looked very, very well, and I'd show you a bunch of charts, but I think you probably know what they look like. It's interesting to see PayPal, Square, all have pulled back, and if you think about a traditional uptrend, a buyable point is a strong uptrend and a pullback, and I think with some of these payment services names, you've seen it happen. I'll finish with looking at within materials. Again, 2 out of my 4 panelists on Saturday both agreed materials was going to be the #1 sector through the remainder of the year. And looking at a chart of the GDX, I see what they're saying, and a lot of the gold stocks look pretty similar. RGLD, Newmont Mining, all sort of in this similar pattern, able to break to consistent new highs on the strength of the underlying metal. That's our segment, Shifting Stocks. And again, there's so many we could get into. We'll find ways to continue to surface individual names, but we need to rotate to the wrap up. 3 charts in 3 minutes, the 3 and 3. Let's do it right now. Chart number 1 is the chart of the XLK technology. Again, uptrends. I like stocks and ETFs making new 52-week highs. I like that too. Divergences where the price goes higher and the momentum goes lower, I don't enjoy. And again, this can change. This is still an active uptrend, so we'll have to see what the RSI does here. But higher highs in price, lower peaks in RSI tells me to be cautious about the potential for dramatic further upside from here without some meaningful correction. Chart number 2, I just showed you. I finished our Shifting Stocks segment talking about gold. And again, if you've not looked at some of those materials names, they're actually doing very, very well. And some of these are a little more in this mid cap range, to be honest with you. But GDX is a good sort of proxy for gold stocks overall. Newmont Mining is the one many of you know, but there are others in that group that have actually done very, very well and teasing new 52-week highs on the relative strength as well. Finally, I just want to point out, not everything is up, and I feel like I've done a disservice if I didn't look at enough downtrends. I skipped energy just because the charts are negative, and I don't mean to do so. Pay attention to some of those areas of the market that are not doing as well. The small cap index was down today, as was the mid cap index. So remember that there are stocks that are actually in downtrends. Airlines come to mind. Now, this seems like a pretty slow and steady downtrend, but remember, this is a huge swing from below 90 to almost 180. This is a double over a 3-week period for the airline index. But you can see it's settled down pretty well to the middle end of that range. And I'm seeing a pattern of lower highs and lower lows. That, by definition, is a downtrend. It tells me to avoid a group like that until you see higher highs and higher lows. That's what I look at there. By the way, if you look at the airline stocks and order them by scooter ranking, the top ranked stock is only a scooter ranking of like 30 to 40, I want to say, at best. Folks, that's our show for today. Thank you so much for joining us. Great guests the rest of this week. So join us every weekday, 6 p.m. Eastern. You're on StockCharts TV. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.